Okay, so this is the end of the quarter uh, episode, and I've been doing, I don't know, for the last 4 or 5 quarters anyway, an economic update. Um, and I'll be doing one right now for the first quarter of 2023. And if we're kind of look at the state of the economy right now, we got a lot of things going on that are, uh, everybody's going to say, well, you're so pessimistic, Trip. Well, I think I have good reason to be. And if you aren't at least being real about what's going on around us, then you're going to have problems later. But basically, the state of the economy, we've got a banking crisis. We've got a war in Ukraine that we apparently have an open checkbook to write checks to. We have excessive government spending, excessive government overreach. We've got energy costs that are unbelievably high. We've got a tight labor market. We've got high inflation, but other than that, it's great. So that's really the state of the economy. And I'll just take a minute here. I'm not going to go through all of these um, economic indicators here, but I'll make a few comments as I go down through these. The currency is the US dollar, hanging out at about 103. Um, you know, everything I read tells me that this thing's going to roll over. Ultimately, first I'm going to say 90, and then possibly 80 by the end of this year, or depending on whether some of the other things that I have I want to talk about later in this episode, it could go lower. The stock market has actually held up fairly well. We've obviously been in a bear market. The GDP growth rate, which to me doesn't really reflect what's going on, but let's look at the GDP annual growth rate. Previous quarter 1.9%, now 0.9%, but compared to what we had been running for a while, that's not all that bad. The unemployment rate has finally started to tick up 3.4 to 3.6%. It has been super resilient. I think it has something to do with a lot of the boomers retiring, and we don't have enough people. And therefore, I don't know whether they're not willing to work or, what the situation is, but the unemployment rate just now is starting to tick up. I think this will get much worse. And non-farm payrolls, we had the blowout number, that 504, it just didn't match anything. Back down to 311. Again, I expect this to continue to roll over. So that we have fewer of those jobs. Inflation still is high, 6.4 to 6%. The Fed funds rate now gone from 4.75 to 5%. Manufacturing PMI actually has held up better than I thought, and it almost looks like it's making a comeback right now, which is really weird to me. But it's still below 50, which just means that we're still contracting. And, non-manufacturing PMI is held up at not shocking. Services PMI up a little bit. Consumer confidence, which is another one that's been fairly resilient. This is one of the things that I'll talk about in my closing comments too, but as long as the consumer continues to kind of prop up the economy, things are not, we won't see the problems and issues, but eventually they'll show themselves because of the amount of credit card debt that we have out there. We've got building permits actually has made a little bit of comeback based off of the 10-year has started to back off a little bit, basically because of the fear of the banking industry, which is just mind-boggling to me. I worked with banks, some very good banks, some were extremely corrupt, some were just stupid, and there's a need for good banking to go on, and I'm not for a national bank. I know there's a lot of conversations about that now, but the government is pushing people with what has happened at the Silicon Valley Bank. They bailed them out, basically. The depositors out, and you can read it any way you want, but everybody knows there's a $250,000 limit on there. But government's got to come to the rescue. Otherwise, people lose their money, especially those Chinese nationals with all the money that they have in the account. So that they had over 250,000 at Silicon Valley. Why we're bailing them, I have no idea. But we set up a whole new tool, a whole new fund with the Fed to do this. So it technically doesn't show up on the Fed's balance sheet, but it will show up in your taxes and inflation, and because they've had to print money in order to make this happen. So let's talk about what I think, where we're headed. And again, you may believe I'm pessimistic. I like to think I'm pragmatic. But I think we're headed towards deflation, based off of a couple of people. It's going to be one or the other. It's kind of like falling off of the balance beam. You're going to fall off one way or the other. One way is going to be deflation. The other way is going to be hyperinflation. So, I think we're going to get deflation first, based off of the leverage that's in the system. And we'll talk about how that works here in just a second. But, deflation comes from monetary policy, increasing the interest rates and declining confidence. It's like watching that number, a decrease in demand, watching the consumer confidence number is really important as we move forward here. Because if the confidence starts to erode, with the consumer, then all businesses will wind up having to pay. So the result is, we'll have of deflation is decreased profits, increased layoffs. Debt is going to have increased interest rates, and businesses and consumers are going to decrease their spending. Now, this is what's called a deflationary spiral, and let me put this thing up here. Shows you the cycle, which is you get falling prices, you have less production, you lower the pay, you get a drop in demand, and then goes back and you get falling prices, and you keep looping through this thing over and over again. So it's a spiral. And, this is exactly what happened. If we look historically, what happened in 1929. And, it started out as a recession, and then there was a decrease in demand for goods and services, which then led to lower prices. And you got people, when prices are lowering like this, and we've not experienced what happened in 1929. We talked about GFC here, but in 1929, as the prices drop, people put off buying things because they said, well, it'll just be cheaper later, so I'll wait and not buy it until, I absolutely have to. But during the recession, 1929 recession, that then became a depression, wholesale price index decreased by 33%, unemployment increased to 20%, and then we had similar things happening during the Great Financial Crisis in 2008, but companies really couldn't afford to drop their prices, so we didn't get the deflationary. Now let's differentiate between deflationary and and disinflation. Um, Disinflation basically meaning we want some disinflation because our inflation rate is at 6%. So disinflation 5.5, 5, deflation next level, type of thing where it just collapses. And so we were able to, in 2008, to avoid the the spiral that accompanies deflation. And none of us experience. I'm not exempt from this. I've not lived through a deflationary bust before, but I just get the sense that with everything's going on, either we're going to fall off that balance beam, it's going to be deflationary bust, or we're going to get hyperinflation. That doesn't happen all at once. It happens very slowly, as they say, and then all at once. But this is the environment that we are going to most likely be looking at as one of the two scenarios. And right now, I would say if I'm to lean off the balance beam, that looks like deflationary, deflation for not just the U.S. but for the world, and it's going to be something similar to 1929. So what does the future hold for 2023? Well, to me, disaster appears to be imminent. So unless we start to shrink government, stop the government spending, reduce regulations on businesses. We've a whole slew of new regulations that come out on businesses, and there is no government without somebody actually making profit and having taxes to pay on that profit. And then we need to chip away on this debt that's out there. So that, for people, cutting spending is part of it, but we're also going to have to, quit reducing taxes too for the short term. Now, that will have to be thought through. But when this happens, as I expect it to, possibly this year, what's going to happen is then you're going to get a huge reaction from the Federal Reserve, and they're going to do everything they can to bail us out, similar to what they did in 2008. You're going to see the quantitative easing. You're going to see a reduction of the rates. They're going to try and save this, but I think they've already made the mistake. The Federal Reserve, by hiking up these rates, the federal funds rate, so quickly, they've really created a situation that is not favorable for the business environment. So start reading up a little bit on deflation, how this might affect your business. I'm giving you a sense of the generalities of it. Read accounts from 1929 of what happened with businesses. The fundamental business of business is still the same, whether it's 1929 and we're more maybe primitive in our goods and services. We actually manufactured more back then, which bode well for when we had to eventually go to war for World War II. And the fundamentals are still the same in 2023. Yeah, we have a lot of technology, but again, the fundamentals are still the same. So that's what I wanted to cover this week. I'll continue to do these quarterly updates. I haven't been wrong. I haven't steered anybody wrong yet. I went back through some of my earlier quarterly updates that I've done for this channel, and if you want more of this more often, I do this weekly, usually over the weekend, and provide an update. It's about 15 or 20 minutes long on my Brains and Bulls channel, so you can look for that on YouTube. But started out, I was in the minority that said that we were headed towards a recession. Today, I'm like everybody else. I think everybody is pretty much planning on a recession. I still hear a few eternal optimists think that we're going to avoid one. I think we were in a recession. I'm not totally convinced that we're not in a recession at this juncture. Some businesses certainly are that I've spoken with. Others seem to be doing okay. But that's what I want. Again, that's what I wanted to cover this week as this quarterly update, and we'll talk again about it in June. If you want to hear more, again, go to the Brains and Bulls channel. And remember, there is always a better way.